Hey, what's up guys? Omar here, broker and CEO of Alden Mortgage and Ome Realty. So it's finally hit us, the inevitable, the housing recession. Housing is officially in a recession. What's a recession? Well, you know what? According to the government, you could go ahead and change what the definition of a recession is based off of whatever it is that your little heart desires. But a recession is whenever something declines 2 consecutive quarters in a row. Mortgage rates are going to start going up. The Feds are going to go ahead and meet. Jerome Powell, they're going to meet next month, which is going to go ahead and increase rates. And then whenever you hear anybody says, oh, the interest rates, mortgages, they're based off of the 10-year T-note or the 2-year. No, it's not. It is the amount that a bank is willing to go ahead and compensate, mitigating risk based off of the Fed fund rate, which is the fund rate between the money transferred from one bank, typically a central bank, to another bank. That's how much it costs. So if the Fed fund rate is at like 3.5–4%, that doesn't mean that interest rates could go ahead and start declining based off of the risk that they're trying to go ahead and insure, because you are making zero money. Now that we got that out of the way, because I heard a couple of people talking about this and it just drives me completely nuts how they think that they know. Especially, don't ever take financial mortgaging advice from a real estate agent. Real estate agents have no idea what goes on in the mortgaging world, and we know everything that goes on in the real estate world. And the structure of real estate, this is how it goes. Real estate agents, then you have your brokers, then you have your mortgaging people, because in the transaction part of the whole entire real estate from beginning A to Z, real estate agents don't do anything except sit back and let us do all of the work. So they send us what's called a signed executed RPA, a residential purchase agreement, where both parties could, there was an offer and then an acceptance. And then they send it to us, and then we go ahead and take care of everything from there, from title, escrow. We go ahead and deal with all the underwriting. We deal with appraisals. We deal with all of that stuff. They just sit back and be like, hey, can you please, oh pretty please, just go ahead and make sure this closed. Which, if you are a real estate agent and you got offended by this, I apologize, but I'm pretty good at it. So if you did want to go ahead and reach out, link in the description below, let your boy know. But let's get on with the mortgage rate update, and then we'll go on with the numbers with the real estate. Why we're in a recession, where are we currently at, and then where do we project ourselves to be? When are home prices going to go down? Because even though we're in a recession, home prices haven't really went down. They actually have a little bit, but not by much. But the 5 different we're going to be pricing out 10 mortgage products as of 8/19/2022. 30-year fix will be sitting at 4.94%. 15-year fix will be sitting at 3.89%. 30-year high balance will be sitting at 5.39%. DSCR loan, which is an income producing property, a rental income property that you're going to qualify you based on the rental income that's coming in versus the debt that goes out, that's going to be sitting at 8.76%. Bank statement loan will be sitting at 7.8%. This is another non-agency, non-qualified mortgage where we do not look at your W-2s, not your pay stubs, none of that stuff. We just look at your bank statements and we see the total amount of debits going out versus deposits coming in. FHA 30-year is going to be sitting at 4.32%. 7/6 adjustable rate mortgage will be sitting at 5.24%. USDA 30-year fix will be sitting at 4.33%. VA 30-year fix will be sitting at 4.38%, and hard money fix and flips are going to be sitting at 9.72%, which all of this has pretty much increased in the past few days consistently over and over. And if you were interested in any one of these products, link in the description below for up to 50% commission rebate or 0% listing on selling your current home. Link in the description below. Let us go ahead and help you out, or at least give us a chance to go ahead and beat your big bank, because that's what we do. We just try to go ahead and save you as much money. Brokers are better. Your boy over here could go ahead and move balance if he could. The amount of loan products that we have is crazy compared to any your banks or anything like that. But the recession on housing, and everybody's like, oh, recession, we're in a recession, home decline. Yes, they did. So there's 2 parts to this, okay? The first part is, yes, people are now kind of taking a step back because there's zero confidence in the whole entire real estate market. Everybody's looking at the real estate market. They're like, this is stupid. What am I going to... The interest rates are going up. Even if I go to an ARM, adjustable rate mortgage, that's going to suck, because then it's going to get adjusted after 6-7 years. I don't know what the market's going to be. There is an uncertainty. But adjustable rate mortgages have gone up because this is the way that we qualify you. We go interest only until 7 just to get you into the house. Now, the trickle method, the trickle effect on this is going to be that majority of the interest rates that are going to go ahead and increase, that it's going to start decreasing the value of the home. So that is kind of another big burden. If you are going to go ahead and get into an adjustable rate mortgage, by all means, okay? I know I do these videos to go ahead and promote my mortgaging business and all of this other stuff, but for the sake of argument, my job is not to go ahead and sit there and force you into something that I personally wholeheartedly in my gut feel is a poor decision. Now, adjustable rate mortgages. Now, let's say real estate prices do go down, right? And you're stuck in an adjustable rate mortgage. In about 5, 6, 7 years, depending on if you got a 5-1 or you got a 7-6 or you 7-1 or a 10-1, whatever you end up getting. If real estate prices do drop, because sales have declined, new builders, what they're trying to do is they're trying to get the 8 months worth of inventory out of their whole entire realm. They're going to build out the next 8 months worth of inventory and then call it a day, because every single person already knows what's happening in the next year, including myself. In the next first, more than likely second quarter of next year is when we're going to go ahead and see a dip riding out into these slow months coming into the October, November, December. October, November, December in the world of real estate, in the world of anything that is sales compiled, when it's not small little tangible things like, you know, like if you're going to go, it's Christmas or it's something like that. But like big purchases, your cars, your homes and all that, that dwindles down in the course of the coming months. Now, when that happens, that means people are going to start dropping prices of homes. And then when they do that, and especially in September, if interest rates, like let's say if they hit us at another, if they went and were smart about it, they'll just hit us really, really big. This is what I don't understand, is if the feds wanted to go ahead and help all of us out, they would have just hit us as hard as they possibly could in the very beginning, because then at the end of the year, what we could have done is we could have tailed it out and then kind of pushed out of this whole entire stupidity that they have going in. So what's the point of doing, let's do 75 basis points here, 75 basis points here, 50 basis points here? Like, it doesn't make any sense. The inevitable is eventually going to happen. We are going to get hit at the high end on the interest rates. We already know the numbers. You know, there's not a bunch of stupid people. There's economists. Everybody is running around. It doesn't take a rocket scientist to figure this out. Just hit us hard one time. Let us suffer for a quarter, because that's what happened in 2008. In 2008, when the whole real estate market crashed, everything went down, jobs went down. It took us about 6 to 8 months to go ahead and kind of start crawling our way out of it. Now, we could have done that a long time ago. If you just hit us in January, well, we're in August right now. Now we would have went into the winter months and kind of like started crawling our way back out of it. But who am I? I'm not over there making the decisions. But as far as the percentage year over year, the biggest percentage change year over year in existing home sales has been now at 20.2% overall in the whole entire United States. California is much more. Los Angeles is way more, because 63,000 and some change. As of this morning, I think it was like 64,000 some change. Existing home sales, people pulled out of contracts, new home builders, everything. The homes that you see right now, as far as the numbers go with the existing home sales, is homes that were signed back in May. That's how far back it goes, May and April. That means that they're still tentative to go ahead and close. And then coming in shortly, this 20.2%, this change year over year, this 22%, don't be surprised if you see that at like, let's say 30 or 40. Don't be surprised. Coming in the next couple of months, keep up to date. Like, subscribe, comment, and I'll go ahead and keep you guys up to date. But that's where it's going to be. Now, in 2020, 2019, end of it, when this whole stupid COVID thing hit, home prices as a national average were between 285,000 and 286,000, which right now we just dived from 413 down to 403,000. Now, where do we foresee us going in the next year? Now, like I said before, this is going to be a slow trickle method. This is just going to, like, little by little by little, because the inventory isn't coming on the list. Before, back in 2008, what happened is, well, everybody just said, you know what? Let's let all the house go to foreclosure. Everybody was upside down. Nobody could afford it anymore. The adjustments hit, and they were just like, I can't refinance out of it. This sucks. So that could, if this goes back down to from 403,800 to from a national average to 286, well, we're still not in a bad position. Then we kind of get into this equilibrium where we're all going to be in the same boat again, back in pre-pandemic levels, which is fine, because it was hovering 250. Then we had a big spike in July of 2019. where it went to 285, but we never really peaked much out of that until as of recent. People have lost their mind. It's like that stupid toilet paper thing whenever this whole pandemic hit. Remember how everybody was going dumb over freaking toilet paper? And then that's what happened in the housing market. People went stupid. They thought that this was going to be the next big thing. Now what happens is if real estate does drop, pre-pandemic levels, the people that did purchase are gonna be in a really, really rough position, because now they do not have an asset that is gonna be producing anything. They have an asset that is a liability, and a huge liability. Now all assets, when it has a mortgage behind it, is a liability, but now you cannot do anything with it. You're stuck between a rock and a hard place. The good thing is that majority of people, they don't mind it. They're like, you know what, I know what my mortgage rate is, I'm comfortable with it. But if everything starts to decline, when the Fed fund rate starts increasing and the smaller tangible things become more, and they can't get a grasp on this whole inflation thing, that means, and then if you guys all saw, there's hiring tech freezes because retailers and people are not putting money back into ads. Google is taking a big tank. A bunch of people are taking a big tank, and they're kind of dwindling back. Now, speaking of tech, if you do have an iPhone, I was reading this thing this morning, go ahead and software update, because most devices, now this was by CNN Business that came out this morning, Apple is directing users of most of its devices to update their software after a company discovered a vulnerability in its operating system that it says may have been actively exploited, in quotations. In security updates posted online on Wednesday and Thursday, Apple said the vulnerability affects iPhones dating all the way back to the 6S. So even those old little ancient artifacts that you have, that's iPhone 6s, God bless it. Well, aren't we like at 15 now, or 28, or 1072? Yeah, so go ahead and update that guy. You know, I know most of you guys do your banking on there, you do text messages, you send personal information, you don't want somebody getting into your stuff, and that's going to be your mortgage rate update. So if you did like the content, please like, subscribe, comment. For up to 50% commission rebate, 0% listing on selling your current home, or any mortgaging assistance, link in the description below. Until next video, guys, I really appreciate you watching. Have a happy Friday, stay safe over the weekend. Until next video, guys, peace.